Hey everyone, welcome back to yet another episode of Ying's Squawk Box. So, a lot of people are analyzing the market right now and they're trying to come up with whatever analysis that they can to trying to predict the future. And then they say that this will do this will do that. But me personally, I put my actions where my mouth is. So, in this episode, I'm going to try to mostly tell you what I've done. Obviously, I'm not trying to play God here, and I'm not going to tell you why this is the case because let's face it, right? No one knows why. If you're trying to understand why stock market works in a certain way, you're trying to play God. So let's just face our reality right now that you're not God and things work in a probabilistic way. There isn't a strict causality saying that if something happened and whatever condition is met, then stock market will absolutely go up, right? There's no such thing. So in this episode, let's turn our attention to the chart real fast. We're looking at Nasdaq, or also known as the ticker for Nasdaq component. This is a tradable ETF. I'll tell you what I did. I bought on this day, so let's put a vertical line. That's why I bought it. I don't know about you guys, but some people may say it's a good buy, some people may say it's a bad buy. In terms of myself, I think relatively it can be a good one because I look at the current price, I look at the average price, as well as some of the fundamental indicators. And comparing with the historical data, the price of this index has been dropping to a certain point, and statistically, it's an unlikely event. And in my book, when something is unlikely, it will not stay there for long. So what that means is it will bounce back up. So that's why I bought it. That's the motivation. Now, that being said, I'm not trying to play God. There's no causality drawn here. I'm not saying that this will immediately bounce back up. I took a shot, right? It's a probabilistic and calculated shot, such that the probability that this price keep going down further, it's so little, such that if I put up this bet on average, it's a winning bet. So that is really the trade here and why I kind of stick with that strategy. And some of you guys also saying that we're in a depression right now and things look really bad. And I heard some of you saying that stock market is going to enter into a bear market and people are out of job. I respectfully disagree. I don't think this is in a depression at all. If you look at the weekly chart and you zoom out a little bit, let's just take a look at the global view, okay? Which part of this do you think is more like a depression? Well, first of all, we have to respect financial crisis in 2008, right? That is a depression, right? You look at the history textbook, you look at whatever book that you can find, people will refer that as a depression. If you think this is a depression, just comparing with the past 10, 20 years, you're going to call any of this spot a depression? I highly doubt it, right? Because the two charts don't look the same. Let's say you call whatever this is in 2008 a depression, and whatever is going on right now doesn't even look remotely like that. How do you expect the same terminology, right? The definition fundamentally contradicts each other. So right off the bat, the definition just won't work here. You can't call what we have right now a depression, the same definition that you gave in 2008. You can call it whatever you want, but you should not use the same definition, okay? Certainly not a depression. So that's just the first thing I want to mention. The second thing I want to mention is if you look at the length of how this bottom forms, and I think that can probably play a certain role when people are trying to define depression. Let's say we respect this definition that 2008 is a depression. And you look at the same index, right? In 2007, we're hitting about 50. Let's put a trend line. That's going to be a high point. And then you put the bottom line. That's how long the bottom lasted. So it really didn't take off until this day in 2013, until we truly make a bullish run for the next 20 years. So yes, you can call that a depression because the bottom has been lasted for a few years. From 2009, it started from this bottom, and then 2010, maybe it tried to bounce back up a little bit, and then 2013, it finally took off. So if you respect the definition that this is a financial crisis, which you should be doing, then let's respect this point, right? Let's respect the reference point. Let's respect the percentage that is coming down. Let's respect the time length. Do you think today look like that? No, today doesn't even remotely look like this. So whatever definition that you're trying to cook up, depression, frustration, whatever it is that you have for stock market, that is your emotion only. So if it's your emotion, then suck it up, right? In stock market, there's no emotions. We trade the tape, we trade the charts. It's purely supply and demand, purely logic. So that's the second thing I want to say. And then the last thing I want to say is if you look at the weekly chart, we're still above this moving average here, right? Let's put a horizontal line. That's the moving average. I think we're still above the spot. I think overall it still looks healthy. You can probably call this a correction, and maybe somebody short the market here, maybe they've caught it, right? But I don't think shorting is a good strategy here, only if you caught at the right moment, and you do it a few times. If you're shorting all the way from a few years ago, I highly doubt that you're making money consistently. Because overall the trend is still going up. I think shorting, even if you are an experienced trader, I will bet that you will say it's a hard money to make. So I'd rather put my money on the easier bets. So you make your life easier and you make your client's life easier, right? So overall, I think one interesting that you could look at, it's a price with respect to the moving averages. Now I know moving average is kind of like a trading only term. Outside of trading floor, probably not many people refer to moving average. But if you think about it from stochastic point of view, the moving average is really no difference than you take a bunch of number and you compute the average. If the time frame is picked correctly and the data is solid and you have a lot of historical data, in this case you do, then you can kind of respect that average. If you can respect that average, you can also respect the distance between the current price with whatever average that you're looking at. So that information is extracted down here in this indicator called RSI. Now, of course, RSI here, I only use 30-day, right? If you don't like 30-day, you can pick whatever day that you like. You can pick a 50-day, you can pick a 100-day. Obviously, time frame is a tuning parameter that you can change depending on whatever flavor, whatever risk tolerance that you're comfortable with. So I don't know if you guys can see it, but this RSI indicator below, and if you look sideways instead of up and down, you can kind of see that most of the data points fall in the middle point, right? We're talking about above 40, maybe 44, and then maybe below 60. So most of the data points fall into this range, very few in the bottom and very few on top, right? So something like that, you can kind of think of as a normal distribution. Now, obviously, I have not conducted any of the statistical tests, of which you can also do if you want to truly turn this into a quantitative argument. But looking at this chart below and look at plenty of charts, you can kind of tell that most of the data points fall into a certain range in the middle, a few from the bottom, a few on the top. So this gives you a good perspective because this RSI translates the information from stock chart and presents down here in a very sufficient way, in the sense that I know all the information there is, and I can kind of tell which price level is the stock price least likely. Okay, so really make sure the terminology here is correct. I'm saying least likely. So for example, this spot I bought here, if you look at the RSI, it's about 37 to 38. So when I say the least likely, I'm talking about if you look at the past 10 to 20 years of range, 38 and 37 only happened a few times. All right, that's what I meant when I say least likely. And if it happened a few times, what does that mean? It's a small likely event. It's a kind of event that does not happen that much. Okay, so what that means is if the price is at this level and it doesn't happen that much, the probability that it goes down even further is going to be much less than it bounces back up. So that's terminology here, and that's the reasoning here. Of course, if you come from a machine learning perspective, it's going to be very different because of autocorrelation, right? Autocorrelation is going to destroy whatever predictive information that you have, right? So if yesterday it goes up, chances are tomorrow you should bet stock go up, right? The same way reverse. If yesterday the stock goes down and tomorrow your best bet is that it goes down, because on average that's true, right? And unfortunately, that philosophy from machine learning perspective is not able to help you execute the trades because in practice, the trading strategy work in a reverse way. So hopefully this is good information for you, and hopefully this put a calm pill in a lot of your hand. And for those of you who think that we're entering into a depression, hopefully this video provides some new insight. With that being said, hope you like it, and I'll see you in the next video.